early that morning, so many people were coming on CNBC calling for, hey, we need an emergency rate cut. The Fed got it wrong. We need to cut. So what I was saying was going to happen the Friday before the weekend was happening on that Monday. Now, the Feds didn't come through, but I think because the markets recovered, they felt that they probably didn't have to. And one of the reasons for the recovery was yields, short yields collapsed, and the markets began to price in a near 100% probability that we would get a cut in September of 50 basis points, not even 25 basis points. Powell brushed that off at the last press conference. But I said on my podcast that if we didn't get the emergency rate cut, we were getting a cut for sure in September. I just thought they may not even wait until September. They may have to do it sooner. Between that September meeting, bond market started to price that in and rates went down. That helped the markets because the markets saw this and they're like, okay, the Fed is definitely going to cut now. We no longer have that uncertainty of it's data dependent. The market now realizes that the Fed is going to move on in September no matter what. And that, I think that helped the market psychology. The market started to anticipate, okay, we dodged a bullet here. We didn't get the rate cut in July, but it's a done deal for September, so we can stop worrying about it. Now, of course, Powell would have looked a lot more prescient if he had done what I advised. Remember, on my last podcast before the Fed meeting, I said that I thought the Fed should have cut in July based on the economic data. Again, not because it's the right thing to do, but because I know what the Fed is trying to do. And I can see that the economy was weak enough that they could try to get away with a rate cut. And they can claim that, well, inflation is going to keep falling. Well, we've got to be concerned about the employment market, the economy. They missed that opportunity. But then when they did, I said, look, we're going to get a cut in September at the latest if we don't get an emergency cut before that time. So that helped the market recover. Everything recovered. Bitcoin recovered. Of course, it didn't recover everything, but it recovered. And then the markets pretty much rallied all week long, so that by the end of the week, you barely knew that we had that crash. In fact, the Dow was down on the week, only about 0.5%, maybe a little bit more than that. S&P was practically unchanged. In fact, I forget, it was down a little, up a little, but it was almost unchanged. The NASDAQ was down, I think, 0.2% after being killed, right, on Monday morning. And some of the big tech names were just, on Monday. The Russell 2000 was down about 1.4%, I think. Gold ended up settling down about $7 or $8 on the week. After all that volatility, it only closed down $7 or $8 on the week. The gold stocks, though, they got hit a bit. They were down 2% on the week, but they got shellacked on Monday. It was a great buying opportunity in those gold stocks on Monday.
If you've been paying attention, you know that the markets are shifting and fast. Peter Schiff has been outspoken about the current state of the economy, the misleading narratives around it, and the role that precious metals will play as we move forward. So let's dive in. Early that Monday morning, there was a lot of noise about needing an emergency rate cut. People were coming on CNBC pleading with the Fed to cut rates immediately, suggesting that they had made a mistake by keeping them so high. There was panic, and the sense of urgency was palpable. But here's where things get interesting. The markets recovered, and suddenly the narrative shifted. Why did they recover? Yields on short-term bonds collapsed, and the markets began to price in a near 100% probability that the Fed would cut rates by 50 basis points in September, instead of the usual 25 basis points. Jerome Powell may have brushed this off at his last press conference, but Peter was quick to point out that if we didn't get an emergency rate cut in the immediate future, a September cut was almost certain. Now let's take a moment to appreciate how the markets work. The moment traders heard whispers of a likely rate cut, sentiment shifted. Suddenly, the fear of high rates subsided, and the market saw an opportunity. Stocks rallied throughout the week, and by Friday, the damage from Monday's crash was almost erased. The Dow finished the week down by only 0.5%, the S&P 500 was nearly flat, and the NASDAQ was down just 0.2%. It was as if that Monday never happened. This is classic market psychology. When there's a clear indication that the Fed is going to act, markets take that as a green light. Investors breathe a sigh of relief, thinking, the Fed's got our back, However, Peter Schiff pointed out that Jerome Powell could have looked far more proactive and precise had he acted sooner. Back in July, Peter argued that the Fed should have cut rates based on the weakening economic data, not because it was the right thing to do in the grand scheme of fiscal responsibility, but because it would align with the Fed's own goals. The problem is that the Fed missed that opportunity. They hesitated, and now they're trying to play catch-up. If they had cut rates earlier, they could have tried to justify it by saying inflation was going to keep falling and they needed to support the employment market. Instead, they hesitated, and now they'll likely have to cut rates under more stressful conditions. What does all of this mean for gold and silver? Well, quite a lot, actually. When the bond market starts pricing in rate cuts, yields on short-term bonds collapse. This is exactly what we saw happen, and it played a significant role in calming the stock markets. Lower yields mean that bonds become less attractive to investors seeking returns, which drives them towards alternative assets, such as gold and silver. As the Fed signals a dovish stance, the US dollar weakens, which is another tailwind for gold. A weaker dollar makes gold, which is priced in dollars, cheaper for foreign buyers. It also indicates that the purchasing power of the dollar is deteriorating, prompting investors to seek the safety of assets that hold their value over time. Peter Schiff made it clear that we're not just looking at rate cuts here. The Federal Reserve will eventually have to return to quantitative easing, QE, and in an even larger dose than before. Rate cuts alone won't be enough to prop up this over-leveraged economy, and the balance sheet is about to explode once more. This will put significant downward pressure on the dollar and push gold prices higher. Despite the looming rate cuts and the apparent failure of central bank policies globally, including Japan's surrender on rate hikes, gold and mining stocks have yet to fully reflect the bullish environment they're facing. In fact, gold was down slightly last week, and mining stocks were hit harder, even though the fundamentals for both have never looked better. Think about it. Japan, which had just barely raised its rates above zero, has already given up on further hikes. The Federal Reserve is following the same path, preparing to cut rates again as inflation gets ready to roar back. The economy is officially entering a recession, even though Peter has argued that we've been in an unofficial recession for quite some time now. And yet, gold was down and mining stocks were down. This is exactly what Peter calls a buying opportunity. The dollar ended the week flat after hitting a 4-month low. It's a clear sign that the greenback is preparing to roll over. Once the Fed starts cutting rates, and when they inevitably return to QE, the dollar is going to face intense downward pressure. At that point, it's not just about buying physical gold and silver. You should be considering mining stocks as well.
Didn't just take off. It's just amazing. This was such a bullish announcement that the Bank of Japan has already surrendered on its rate hikes and it's barely above zero. The Fed is also surrendering. They're going to start cutting, but inflation is going to take off just as the economy is officially entering recession, even though we've unofficially been in it for some time. You can't imagine a more bullish environment for gold, for the mining stocks, yet gold was down last week. In the face of this, mining stocks were down. So this is just a great opportunity. You know, the dollar ended the week flat. It closed last week on a 4-month low. So the dollar didn't really bounce from there, but it is getting ready to roll over when the Fed, starts to cut, even before it cuts. And it's not just going to cut, it's going back to QE. Nobody is talking about that, but that is what's going to happen because rate cuts aren't going to do it. They're not going to be enough, right? Quantitative easing is going to be required and an even larger dose than before. So the balance sheet is about to go ballistic. So gold should be rising. And so this is an opportunity not just to buy the metals, to buy the physical gold and silver, which you should be buying. You should give the guys over at Schiff Gold a call. You should also be gobbling up these mining stocks. Again, that's where most of my personal money is. Half my personal portfolio is in gold and silver mining stocks. I expect those stocks to just explode. I think the upside potential is enormous. Not just 5 or 10 baggers, but bigger than that. Of course, there's risk, right? I mean, I've thought this for a while, but the setup is perfect. The fundamentals are perfect, and nobody is playing this trade. The hedge funds aren't there, institutions, retail, nobody talks about it, even though it should be, right? Even though gold is still, gold's at 2430-ish. It's right near a record high. It's barely below its record high. Yet it's a contrarian investment to be bullish. That's how bearish everybody is. So it's just, to me, it's the best opportunity I've seen. So you should be buying these stocks. The Euro Pacific Gold Fund, you could buy it no load at Fidelity, Schwab, any of the big discount brokerage firms, or go to Europac.com and talk to my representatives about how to get into our fund, how to get into our separately managed accounts where we manage a portfolio. And also the Shift, my value fund now it's in the top, I think it's in the top 10%, I forget, maybe 6% year to date. But a month ago, it was near the bottom of the pack year to date. Now it's almost at the top as we're shifting into value out of all the momentum stocks that I don't own. So the strategies are really coming into play, but what's going to kick them into a higher gear is going to be the weakness in the dollar. Once the dollar really rolls over, it's a whole new ball game when it comes to international investing. And the dollar decline is way overdue, just like the gold breakout. And even though gold has moved up, right, we have hit new record highs, nobody's cared, nobody's paid attention. And most of these gold stocks, now some of the gold stocks hit 52-week highs last week and then got slammed on that big drop on Monday. But again, I think that was just frustration because they couldn't push gold above 2,500. Well, once it gets above 2,500, it may never look back to 2,500, right? Because they just may bid it and it'll run away, given where we are right now.
Now that we've established the groundwork of what's happening with the Federal Reserve, the bond market, and the psychology behind rate cuts, let's dive deeper into what this all means for gold, silver, and mining stocks moving forward. The landscape for precious metals is changing, and there are enormous opportunities ahead if you know where to look. One of the biggest misconceptions about the Fed's rate cuts is that they will be sufficient to stabilize the economy. Peter Schiff has been vocal about this fallacy. The fact is, rate cuts alone won't fix anything. In an economy as leveraged as the United States, where debt is at unprecedented levels, a reduction in borrowing costs isn't going to provide the kind of economic stimulus needed to offset the downturn. This is especially true given the weakened purchasing power of the U.S. consumer amid rising inflation. This is where quantitative easing, QE, comes back into play. QE is essentially the process by which the Federal Reserve buys assets, typically government bonds, to inject liquidity into the economy. It's an artificial boost, a way of printing money without literally printing paper bills. And while QE may provide a short-term sugar high to the markets, it ultimately devalues the currency, contributing to inflation. The irony is that the Fed's move back to QE will coincide with inflation that is already stubbornly high. They'll be trying to fight a slowing economy with monetary easing, which will only exacerbate the problem they're supposed to be solving. For gold and silver, this creates a perfect environment. When inflation starts to take off, the value of fiat currencies like the dollar declines. Investors flock to gold and silver to preserve their purchasing power, pushing up prices. Another critical element to understand is the trajectory of the US dollar. The dollar has been strong in recent years, thanks largely to the Fed's aggressive rate hikes. Higher interest rates attract foreign capital, increasing demand for dollars. However, as the Fed begins cutting rates, the appeal of the dollar diminishes. Peter Schiff emphasized that once the dollar starts its decline, it will mark the beginning of a new era for international investing. The days of the dollar being the king of global currencies are numbered, and as it loses value, international investors will need to reconsider where they put their money. This shift will be highly bullish for gold and silver. Let's not forget that gold is priced in dollars, so when the dollar falls, gold becomes cheaper for investors using other currencies. This creates more demand, which drives up the price. On top of that, a weaker dollar is a clear signal that U.S. economic policy is on the wrong path, which makes gold an attractive hedge. While physical gold and silver are essential parts of any investment portfolio, mining stocks offer leverage exposure to rising metal prices. Essentially, when the price of gold or silver goes up, the profits of mining companies increase disproportionately, leading to potentially massive returns for shareholders. Peter Schiff pointed out that half of his personal portfolio is invested in gold and silver mining stocks. This is a bold move, but it's based on sound reasoning. Mining stocks are currently trading at prices that don't reflect the bullish fundamentals for precious metals. Investors are ignoring these stocks because they still see gold and silver as fringe investments. But that's exactly what creates an opportunity for those who understand the market dynamics. Consider this. Gold prices have been hovering near record highs, yet mining stocks have remained relatively undervalued. Some of them even hit 52-week highs before getting slammed again during Monday's dip. This volatility presents a buying opportunity, especially for those who believe that gold will eventually break above $2,500 and never look back. It's not just about price appreciation either. Many mining companies have been improving their balance sheets, paying down debt, and increasing dividends. This means that investors aren't just looking at potential capital gains, they're also benefiting from income through dividends, which is a rare combination in today's low-yield environment. Another factor that cannot be ignored is the impact of geopolitical and economic events on the precious metals market. Central banks around the world have been net buyers of gold for over a decade, with countries like Russia, China, and India leading the charge. These nations are diversifying away from the dollar and increasing their gold reserves to protect against a declining U.S. currency and geopolitical risks. For example, just recently, the Bank of Japan made headlines for effectively surrendering on rate hikes. Japan's decision to abandon its rate hike strategy, despite inflationary pressures, is indicative of the broader challenges facing central banks globally. The key takeaway from all of this is that the financial landscape is shifting. The Federal Reserve is preparing to cut rates, return to QE, and devalue the dollar, all of which are highly supportive of higher gold and silver prices. The fundamentals for precious metals have never been better, and yet most investors are ignoring them. Peter Schiff has been warning for years that the current monetary policy is unsustainable. The Fed's actions have created bubbles in stocks, bonds, and real estate, and when those bubbles burst, the fallout will be significant. In times of crisis, investors flock to assets that are tangible, finite, and have intrinsic value. Gold and silver fit that bill perfectly. Mining stocks, too, present an incredible opportunity for those willing to take on some risk. These companies are sitting on massive reserves of gold and silver, and as prices rise, their profits will soar. The market hasn't recognized this yet, but when it does, the gains could be substantial. In conclusion, we are at a critical juncture in the financial markets. The Federal Reserve's upcoming rate cuts, the inevitable return to quantitative easing, and the declining value of the US dollar all point to a strong bull market for gold and silver. Despite this, most investors are still focused on stocks and bonds, ignoring the incredible opportunities in precious metals and mining stocks. Peter Schiff has been clear, now is the time to act. Whether it's buying physical gold and silver to protect against inflation or investing in mining stocks for potential outsized gains, the setup is perfect. The fundamentals are in place, and the rest of the market has yet to catch on. So don't wait until it's too late. The window of opportunity is open, but it won't be for long. As the dollar declines and inflation takes off, the value of gold and silver will become undeniable. Be proactive, position yourself now, and ensure that your wealth is protected in the uncertain times ahead. Whether you are an experienced investor or just getting started, there has never been a better time to add gold, silver, and mining stocks to your portfolio.